Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
And why do they do it? As we said, they make money on the spread. That's it. Make money on the spread. Your borrowing cost, versus your return on investment elsewhere. That spread represents the money you're going to make. So, again, the simple example was Australian dollar. 6.5%, borrow at 0.5%, you have a 6% yield there. Now, if you're in a hedge fund and you can leverage that up, or if you're an individual, have the ability to leverage that up, which individuals now do with a lot of spot forex accounts and things, and you leverage that up 10, 15, 20 times, you can see how much money you're making on the spread, just the yield alone, plus leveraged up, plus potential capital appreciation. It's a very, very enticing trade. And that's why people did it. And we will show you the reason they did it, because the environment was set up. The environment has changed now, but if you understand the theoretical environment that you need to make sure you limit your risk in this, I think that's the key. So as I said, it was kind of a slam dunk for hedge funds. They made this trade, all day long. And we saw it in the numbers. And again, we'll use the yen, for example, because that's where we had some numbers. In the height, really, of that carry trade before 2007, when the trade broke because of the credit crunch, there was an estimated at least 1 trillion plus, could have been more, in the carry trade, meaning 1 trillion borrowing of yen. And then if you multiply that, from a leverage standpoint, up 10 times maybe, leverage up, you're talking about 10 trillion potential spending from this carry trade that boosts markets. So you can see why there was so much liquidity driven in these markets during that past cycle. These big differentials in currencies, yields created these carry trade opportunities, which ended up into self-feeding, driving capital behind a lot of these markets, these risk asset classes, commodities, and things like that. Japan was a big player themselves in the carry trade. You have to keep in mind, and this is something that's still probably in play, to my chagrin a bit, Japanese retail investors and Japanese institutional investors still have a lot of money. They generally have a lot of savings, and because they're paid so low in their own deposit accounts, even still, they tend to move money offshore. It was quite interesting that the last big wave of investing from the retail investors in Japan was into Russian ruble, Brazilian real, New Zealand dollar, just before the credit crunch. So they, once again, Japanese are very, very smart people, but they're very, very bad investors. They tend to be very herd-like and very collective in their movements. But in general, a lot of this carry trade that hurt the yen was from the retail and institutional investors themselves wanting to get money offshore, involved in higher yielding opportunities that weren't available at home. So you not only have this from external international investors coming in and borrow yen, because the yen is what we're going to talk about here, towards the end, but you also had a domestic carry trade going on, and we still see part of that lingering out there that still, I think, leads to a lot of volatility in the yen. As I said, the Eastern Europeans play the carry trade in a very, very big way using the Swiss franc because it was a low-yielding currency in Europe, and the banks in Europe are very, very happy to go into all these countries and lend Swiss francs in a very, very big way, because the emerging markets of the world in general don't have an internal market. They don't have an internal source of capital, i.e. a capital market, a bond market, or still sophisticated domestic lending institutions. The emerging markets of the world are still highly dependent on international lending from banks. And with all the liquidity being poured into Europe based on the movement of the euro, based on the fact that a lot of the European banks could could borrow at relatively low yields because of the European Monetary Union and that distortion that was created there. You also had the Swiss franc that was very, very low relative in a relative sense. So these banks were happy to pump money into these countries for the fees and everything else when everything was going one way, and the Eastern Europeans were very happy to get the access to this cash. They were creating new empires in the process, but that game has changed in a big way, and we'll show you why. So that's why, to make money, and it really is the spread. You're investing in something higher yielding than your borrowing cost, and that's why we say if this basic opportunity is set up, it doesn't really matter what the currency is. It doesn't have to be the yen. It doesn't have to be the Swiss. It can be something else. It can be the low-yielding currency. When I was preparing for this presentation earlier this morning, I went back and looked. I did this presentation on carry trades back in October of 07, and what was interesting, I just took the yields. These are 3-month yields that come from The Economist magazine at the time, and these are the 3-month yields from The Economist magazine today, and it was quite fascinating just making this comparison. Since this was just before the credit crunch, or right around, when the credit crunch reared its ugly head, and you look at these changes in interest rates, and it's quite stunning. At the time, 2.8% seemed low as a funding currency at the time in Switzerland, you can see. Japan and Switzerland at the time, relatively low compared to the other major currencies, Australia being the highest yield, and they've fallen dramatically themselves. The yield in Australia has been cut in half, but the fact that it's been cut in half still makes it the king on the street, because when you look at what happened to the other yields, UK, for example, who would have thought the UK would have gone from 6.2% to 1.3 in that time frame? So we've seen a tremendous push down in yields. Look at the US. We've gone from 4.81 to 0.32 on a 3-month basis on yields. I mean, it is. It's just stunning when you look at these changes, when you just a little bit of retrospect. So as we said earlier, Steve and I were discussing, well, maybe given the fact that all of a sudden the US right here, and surprisingly, Canada's 3-month interest rate very low. Maybe the U.S. Becomes the carry trade currency in this game. And I think we're actually seeing some of that right now. What I've done right here, and I didn't have the emerging market currency yields in. I could have gone back and looked them up, but it doesn't really matter for this example. They've fallen too, but not nearly as dramatically, I don't think, as some of these. But look at something like Brazil. Brazil, one of the key BRIC countries, the B in the BRIC countries. Currently, short-term yields in Brazil are 10.16%. So say you borrowed U.S. dollars and you bought Brazilian currency, or you bought Brazilian stocks, or anything in Brazil that's been going straight up lately. That's been a pretty good trade right there. Borrowing at 0.32 or whatever, you probably couldn't have borrowed this low given the constraints in the U.S. capital markets. But the differential in the U.S. short-term yields relative to Brazil sets that up as a carry trade, and I think this is part and parcel to this move we've seen in the BRIC countries, and this return of just pumping up of the asset markets in China, in Russia, Brazil, and India, and in emerging markets in general. The U.S. yield is lower, and you may have noticed, the big reserves that were recorded recently in these countries again, the big boost in dollar reserves, and I think this goes to a little bit of the carry trade going on here, and the U.S. is not unhappy to see that U.S. dollar-based credit running offshore again, and people are very happy to make this trade. So in the midst of this move in Brazil, not only have you had this yield differential, if you invested in stocks, your stocks would have soared, even relative to the U.S. If you invested in the Brazilian currency, it's increased, so you had a double whammy. You could have had, borrowing U.S. or one of these and then investing in Brazil. Brazilian currency is strengthened against the dollar, so you had capital appreciation plus a significant yield appreciation, and that's a driver for currencies.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.